Hey everyone, Eric L. Dunavant. Thank you so much for being with us. This is Paradiem's first quarter portfolio outlook and update. We're going to go over everything that's happened over the last quarter within the portfolios. We're going to talk about what changes. We're going to talk about what we're watching as the quarter goes ahead. And then Carson and I are going to spend some time really talking about the work that we've been doing, he's been doing, on the back end to really make us even better. Our goal of trying to even serve better and steward better the assets that you've entrusted us to help partner with you on. Before I get started, you know we have to make the lawyers happy. So I'm going to read our disclosures and then we'll dive right in. Paradiem LLC is a registered investment advisor. This webinar is provided for informational purposes only and does not constitute investment, tax, or legal advice. Past market performance is not indicative of future results. All investing involves risk, including the potential loss of principal. Market commentary reflects opinions as of the date of publication and is subject to change. Advisory services are provided only pursuant to a written advisory agreement. And with that out of the way, Carson, thank you for joining me.
Absolutely. So what I wanted to start off with is sort of what we saw happen in Q1. And something that you mentioned in our last webinar actually is on average what we see is that the market, the overall market, will experience about a 14% drop every year. Usually in the first half of the year. And that's a normal thing that we're sort of used to. And, we have plans for every situation. But what we saw actually was almost a correction. A correction is 10% down from the broad market. We were down 9.82%, or the S&P 500, the broad market was. And I know you've got your audit with you. One thing that we saw is while the S&P had that full correction, our dividend portfolio specifically never entered into a negative territory. And I wonder if you could go over the stats of the bear market and bull market capture to sort of explain why that is the case.
Yeah, I definitely want to go over that. I think the thing that's important, let's go back to kind of our overall principles. We're not going to be 100% right. We're never going to be 100% right.
Nope.
What we talk about is that we want to use uncommon sense to help shape the way that we think about things. So one of the things we've been talking to everyone about is that we think there's increased risk in the overall market, period. Whether we got that 14% correction early on or if it happens later in the year, I have been telling everyone, and I'm going to say this right here before we even get even deeper in, and the question you ask is going to be relevant, but I'm going to set the stage around it really quick, is when people are asking me right now, I think there's a 75 to 80% chance that sometime in the next 12 months, and I wouldn't be surprised if it's this year, we enter a bear market. That's 20% down or more. What that means, though, and let's just really be honest, is there's a 25 to 30% chance that we don't.
Yep.
And so the one thing that has kept me probably voting against it more than anything is there's too many people talking about it happening. There's a whole lot of people out there saying, oh, no, there's going to be a bear market. Well, usually the market does exactly what you don't expect it to do. So if you want to know why I'm hedging my bets, that's the number one reason I'm hedging my bets. I'm still concerned about where we are economically. I'm still concerned about how overpriced the stock market is. And so with that, now let's move into answering your question. When we started this year, and as we've been having portfolio reviews, what we've been talking about with people is let's look at the assets that we own. Let's look at why we own them. And so we've got our dividend portfolio and our growth portfolio. The dividend portfolio is typically, not always, but typically been less volatile in down markets and more uncertain markets than a growth portfolio has been. So we've taken our clients, even our most aggressive clients, are 70% in dividend right now. Because if we were going to talk about the growth portfolio was down.
Yes.
Earlier this year.
Yep.
So
more volatile.
More volatile. So we were looking at the first quarter of this year. We just got our audited numbers for March came in on Friday. Year to date, as of March 31st, the dividend portfolio was up 5.5%. The S&P 500 was down 4.37. It's almost a delta of 9% between those two. And that just is part of the discipline of this uncommon sense of we look at this and go, hey, we think there's going to be extra volatility. We have some concerns. We're going to just position and use that uncommon sense. And that continues to serve us really well, just using that. And I think we'll get more into kind of what that looks like today. But why does that matter? Well, they've run some statistics. We've been running this dividend portfolio since 2012 is how far our audit goes back. And what they found is historically, when the market goes up, we capture about 97.6% of that. And when the market goes down, we capture only about 82% of whatever it goes down. So the other interesting thing that you really pushed me on this last quarter was we've been running our dividend audit against the dividend indexes. And through a lot of the work that you've been doing, you were like, hey, go look at that dividend portfolio against the S&P 500 and just see how it's been performing. And what we found out is it has been beating the S&P 500 over longer periods of time, especially as we've been kind of dialing in our management. I think we know it's been beating the S&P 500 for the last 7 years consistently, but it doesn't beat it every year. And so, when people are comparing this, what does this mean? Well, it comes back to A, discipline, and B, understanding this idea of up capture and down capture. There's going to be ups in the markets. There's going to be down in the markets. To give you an example, so this year we were up 5.5%. The market was down, S&P 500 is down 4.37, right? And so the S&P 500 is not you can't directly invest into the S&P 500. So we're using comparable index funds that you can buy that show you what that looks like. We had, over a 1-year basis, because of that, we're outperforming the S&P 500 and the dividend index almost 7% on a 1-year basis. We're averaging 24% over the last year. Past performance is no indication of future results. But I could look at, like 2024, we were up 17%. S&P 500 was up 24.89. We did beat the dividend index. 23, we're up 24%. Dividend index was only up 1.12. But the S&P 500 is up 26. So if you're someone who's only comparing to the S&P 500 on certain years, you might be like, well, hey, you guys didn't beat them. Well, no. But in 2022, because down market capture matters, we were down 2.27. The S&P was down 18.
Yep.
And it's about looking at what and knowing what we can and can't control and trying to just be intelligent about how we do it. So that maybe kind of frames some of what you were talking about.
Yeah, I'm glad you shared that, because if someone were to ask us, like, why are we performing well against our benchmarks, I think that's the main reason. If you just look at that one stat, we capture only 82% of the down market while still getting most of the up market.
That's so the audited performance numbers tell us that that's what happened since 2012.
Yeah. So what else happened this year so far in Q1? We obviously had a war start in Iran.
It hadn't ended. It's still going on.
Yep, still going on. And that's the crazy thing, is the Strait of Hormuz will close and then open and then close.
Yep.
And that's the part of the market, it's called market risk. That's the part of the market that's completely unpredictable. Well, really, I guess you could say the market in general is unpredictable. But, that sort of thing, like we'll get news about the war, the market's up. We'll get news about the war and the market's down. And oil has been trading almost exactly in an inverse relationship to the overall market, and there's reasons behind that. One thing we're going to get into when I talk about the buys and sells that we ended up doing this quarter for quarter two is that most people understand what's going on with oil right now. And one thing that people aren't giving as much attention to, but is still probably equally as important, is fertilizer and the production, I guess you could say, of fertilizer, things like ammonia. And due to the war, 30% of the world's annual production of fertilizer coming from ammonia is offline, just blew up, right?
Yep.
And that sort of thing takes 3 to 5 years to rebuild. And so based on that information, this is part of research revealing opportunities. It's part of thinking like an owner is there something that we could add to the portfolio that sort of makes sense when you hear something like that? And the other thing that we were looking at is America in the past, few decades has been very good at services, and we look at something called the ISM Services Index. Over 50 is growing, under is contracting. it's steadily, on average expanding, and it has been. What we haven't seen is industrial production in America or non-services expanding for a long time.
Yep.
We've just recently had 3 months in a row of expanding. So the reason it's important is because it's sort of, I won't say unprecedented, but at least for modern times, it's unprecedented. And what we can do is actually look at in past results, past
performance is no indication of
Yes.
future results.
Yes, but what we can do is look historically and see, there's some sectors that actually, on average, outperform the S&P 500 that actually produce some, what I would call alpha against the indexes whenever industrials are expanding. So we'll talk more about that in a second. Is there anything else you wanted to
No,
touch
I
on?
think the one thing that I would tell everyone who's watching is what I want you to see, and you're going to hear in today's conversation. Carson came in a year and a half ago to work with us, and we built the philosophy and built everything off of the 3 really core principles: think like an owner, simplicity over complexity, and research reveals opportunities. And so I've been managing the portfolio back since 2012 based on those 3 principles and building ideas and concepts around how we actually execute that. And part of your job in coming in was like, Carson, help me take a look at this, and how can we quantify it better? How can we take the research that's out there and really, we've gotten good results, but can we tighten it? Can we get even better at what we're doing? Can we think better about what we've been doing? And you've been doing that. And so as we kind of go through this, I want you to talk about just some of the things that you've created, some of the tools and resources that you've taken that we've refined. Because as we have this conversation today, I'll give you an example. It used to take us, when we do a quarterly review of the portfolios and make any decisions, it would take the investment committee 3.5 hours to come up with some of our investment decisions. And that's been extremely shortened down. But not only that, I think you talk a little bit about this, some of the research reports and things that you're getting to us faster. I mean, we even talk about this, you can get subscribed to the Rich Report, which has our weekly economic news. Well, this is some of the stuff that we're watching and you can get subscribed to. I mean, this is coming out on a regular basis. We got market briefs and things like that you're able to get to us that we can watch. You've even refined how we're kind of screening and more quantifying, looking at our companies and looking at sectors and taking the information that we have. So I would almost say it's like, imagine that you've got a camera and you think you're focused in on something, and then somebody introduces you to a microscope. And you thought you could see really clearly what you were looking at. What I feel like you've added is a microscopic element of taking what we're doing and doing it even better.
Yeah. Yeah, and so what I'll do is I'll sort of explain, like you just mentioned, some of those reports and how over time it leads to opportunities. The research reveals opportunities, and I'll explain the opportunities that we had in terms of trading for this quarter, if that's okay.
Yeah.
So what I've sort of added for the investment committee is every morning we have a morning brief, and every day after market close we have a market commentary. And the power in that is that we're not really missing a beat, if that makes sense. We understand what's going on at all times. And the power of that is, like, we don't have to scramble at the last minute and read a bunch of articles and figure out what's going on and make decisions based on that. We have a full feed of information coming, in the morning, in the evening, and then also the Rich Report, which is a broader view of everything once a week. So we have all that information coming in on a daily and weekly basis. And then from there, what I've been doing is creating research reports because, I'll see something interesting like fertilizer, for instance, I brought up, or the ISM non-manufacturing, or manufacturing, I mean. I'll see those things come up and then be, interested, like, what does this mean historically? And I'll create a full research report on that topic. And what that leads to is, like you mentioned, looking through a microscope, I guess you could say, really, I guess, an advanced level of clarity. And the screener reports, we used to have something, and we still do, but we had a PowerPoint presentation called the Excellence Evaluation, which was basically just going over the 3 I's, the innovation, infrastructure, and inspiration. That's still a part of the screening report. But what I've also added is For clarity, explain the infinite game, if you don't mind, real quick, and I'll continue.
Yeah, I know. So there was a book written by Simon Sinek, who's an author. If you don't know Simon Sinek, it is worth going on YouTube and watching a video that's maybe about 15 years old called Start With Why. That was one of his first books. He wrote a book called Leaders Eat Last. He's just a thought leader. But he wrote a book called The Infinite Game. And inside of this book, what he found was there are two different ways to live life. One way is to live it as in, I have to win. And the only way that my winning is all that matters. And the second thing that he found is what I think a word we would use, which is just this idea of stewardship, is that I win by preparing the next person to come in and succeed behind me. That's how I truly win, is that success goes on for generations. I mean, we talk about this idea that we want to align family and capital with a 100-year vision. That's stewardship. That is alignment. And what he found is that businesses get run either with a short-term view or this, again, the book is called The Infinite Game, or with a long-term view. And that the companies who play the infinite game perform better over the long term. And so we started looking at, are they playing a finite game? We started trying to quantify and look at, and that's something I think you've really brought a whole lot of, we're going to see some changes in the portfolio on companies we thought from some of our outside, we're playing an infinite game. But then we were able to get the microscope out and go, oh, wait a minute, they're not. They're playing a finite game, so we probably ought to make some changes to the portfolio. But that's the idea, is are you playing to win in the short term, or are you playing a longer-term gain? Because again, uncommon sense and the research tells us those companies who play an infinite game typically outperform those that don't. So again, just trying to put more odds in our favor as we think about that.
Yeah, we want companies that are in the infinite game.
Yep.
Yeah. I'll go over what we did in both portfolios real quick, and we'll tie that all together. In the dividend portfolio, what we ended up doing is there's a company called Matson that we've been holding for quite a while. We bought a quarter last quarter on selling it. We decided to go ahead and make that decision this quarter. And really the reason for it is, I would say, two main reasons. The above all else reason is that there's not enough average daily volume. There's not enough trades on a daily basis for Matson for really a firm of our size to be able to trade that consistently quarter in and quarter out. So it wasn't a fit for us anymore from that perspective. The other reason is we sort of had a great opportunity to sell, and I mentioned this last quarter, but the all-time high before it had dipped last year was $167 per share, dropped all the way down to $87 per share. We were still holding it as a part of our discipline and our rebalance. We bought low, as you would, just based on those weights. And we rode it, all the way back up to an all-time high. So we were able to sell pretty close to that all-time high. So it was just perfect timing.
Well, let's talk a little bit about that, because there are two things going on that I think people, as we've continued to grow as a firm, one of the things that you have to look at is we've got to manage everyone's accounts. And so volume of a security matters. It's something that you can go in and you can try and sell something, and it's called moving the market. You're pushing so much volume in on an order that you move the price of the stock to your negative. Or if you're trying to buy it, you could make it too expensive. And when that gets to be the case, this happens with a lot of money managers. You go, okay, we've got to then limit what it is we're going to buy. This, to us, works okay because we're not having to own hundreds and hundreds of companies. Simplicity over complexity. We only need to find 25. With the new research process that you're putting together, it's easy for us to go in and go, oh, here's a great replacement. That's the first thing. But the second thing I think that comes back into the discipline, that because we're having this go on a lot right now, Lamb Research, we've held for a year.
A year.
And past performance, no indication of future results. This is not the result of everything that we buy. It was up 300% since we bought it. And we've been having conversations with a lot of people. It's like, well, why would you sell it? It's like, it's not. When you put emotion into something versus discipline, that's where I find we make mistakes. It's like, no, the discipline says when it gets to be too big, we simply prune it back. What we did do is it was up 300% in about 6-7 months. We held it through 12 months. Why? Because that turns to a long-term capital gain versus a short-term capital gain, and the tax differentiation in that is huge. But we've had a lot of people say, well, calling them up and saying, hey, just want you to know, we are going to have a tax issue with this. And do you want to do anything to mitigate that? Some people have been donating shares and doing that. But I've had people say, well, why are we selling if it's done so well? It's the discipline. Trim it back when it's there. We do the same thing. We take winners and we trim them back. We also, if the stock fits in the discipline, you may have a stock that's down significantly, like Matson was last quarter, down to 87.
Yep.
Right? From 168 or 169. And we bought in. It wasn't emotional. It was a discipline. And then now that we've realized that our volume has grown to the point that we can't hold Matson any longer, we're selling Matson. But the people who bought in back at, when we bought in earlier this year, we're now selling at almost double on that purchase. And it's not anything magic. We just followed the discipline of what we've been doing all along. And that's why I think sometimes that's uncommon sense that, people want to just get emotional about how they make decisions. It's no, just follow the discipline. Yeah. Follow the discipline. And we see that work its way out here. And the same thing I'm going to tell you is with Lamb, why would we take the profit? Because maybe an AI bubble pops or something and it goes down and we took a significant profit off of it. I mean, I don't have any forecasts that know what's going to happen. But you may be in more danger of holding that stock longer term than simply be disciplined to take the profits.
Especially in the fact that there's, like you mentioned, there's opportunity cost. And, well, what if there's something low that's a good buying opportunity? And you would normally take those funds and put it into something that's underweighted. What's the opportunity cost there of not rebalancing and actually reaping those rewards from that, But yeah, so Matson we did let go for those reasons. Moving into Q2, we also sold out of a company called Agilent Technologies, which was in healthcare. Actually a good company, really is a pretty good company. But again, we're not just looking at that. I mentioned briefly, due to manufacturing expanding, I started digging in a lot to what sectors tend to outperform when we see things like that happen in really all kinds of different situations. I did my own version of an audit of our weights in each sector of our portfolios. And we were really high in healthcare and dividend when the current macro events didn't necessarily call for that, I guess you could say. We still have a good percentage of our portfolio in healthcare, and it's actually, along with consumer staples, it's those two are typically pretty resilient in down markets and recessions, things like that, because you're still going to need healthcare.
That's right. That's right.
It sort of is a consumer staple.
Yep.
So it's good to have, and we still obviously have that in our portfolio. We just had too much. But the trick there is, okay, if we want to sell a healthcare company because we're too weighted into healthcare, what do we replace it with? What we did was we looked at this company called Nutrien, and Nutrien is a fertilizer producer in Canada. So they are far away from everything going on in the Middle East right now. And if you just look at basic economic theory of supply and demand, right? If 30% of the world's ammonia is just shut down basically, in a day, what happens is the demand for pretty much all, especially companies that aren't in the Middle East, but pretty much demand for all fertilizer producers goes up.
That's right.
So it sort of just followed the logic there, sort of decision. So it made perfect sense for us to replace it with a company like Nutrien.
Well, it'll be interesting to watch and see. I mean, we don't know for sure what's going to happen. Everything that we do is about looking at Wayne Gretzky. May not be anybody you know the name of, but he's a very, very famous hockey player. A lot of the people more my age are going to know. Wayne Gretzky won a lot of championships in hockey, but his comment was, you skate to where the puck is going to be, not where the puck is. And that's really our goal of research revealing opportunity, is to take a look and go, okay, so where are the things maybe going to be? And everyone is making noise about oil prices right now. And I sent you an article over the weekend. We're just now, so we made this selection on fertilizer a couple of weeks ago. I'm just now starting to see other people start to talk more and more about fertilizer, and we've already made the move. Again, time will tell whether or not that was exactly where we needed to be, but it just shows it comes back to the discipline. There's one other thing I really want to say thank you to you for on this work that you've been doing that I think makes us better. I have always had this sense that we needed to be paying more attention to the sectors of what we owned. But I didn't have a good disciplined way for us to do it. It was more of I wasn't undisciplined about it, but it was a lot more loose than what you've been in this new process been able to kind of bring us into. And that was really kind of helpful from this Agilent standpoint to go, hey, this is a good company, but we're sitting in healthcare at the same time that the puck is going here. It doesn't look like having this much healthcare makes as much sense. What if we trim this back here? The puck is going here, and let's make this shift. And so that's something I appreciate about this element of what you've been adding to what we've been doing on all the sectors in the dividend portfolio and the growth portfolio to help us kind of go, okay, based on these trends, fertilizer, based on the industrial production, based on these things, this looks like where the puck is going. And so not only are we looking at the companies, but we're looking at how we've got the sectors allocated in the portfolio. And let's just make these slight little shifts and see if this can add a little bit more to what we're doing.
Yeah, absolutely. And the other sort of sector allocation decision we made in the dividend portfolio is we were very underweight in energy based on what was going on. Yeah. If you just think about, the top performing sector year to date has been energy for the reasons that we discussed, oil prices, et cetera. We had 4% of our portfolio in energy. So we replaced Matson with Cortera Energy. And then moving on to growth, like you just mentioned.
Well, I want to mention one other thing real quick because I think this is important. The changes we made raised the dividend yield on the portfolio.
Yes, it did.
And also lowered the price to earnings ratio on. So when we look at the dividend portfolio and we say here, we want to own really good companies, but ideally we want to pay out as much in dividends as we can. And we want to, in an environment where the markets look expensive, we don't want to own the companies that look too expensive. So both of these moves also accomplish a bigger picture of what's going on with the total dividend portfolio. I think it's worth not skipping over that. So.
Yeah, absolutely. Yeah. And like you just mentioned, these changes sort of made things look even better from an infrastructure standpoint of the entire portfolio. And what was the puck thing? What was your...
Skate to where the puck is going to be, not where the puck is.
Let me, without making crystal ball predictions, let me explain what's going on sort of with the data centers and things like that. Is we've known that energy was sort of a bottleneck of the AI data centers and AI in general. And what's interesting is there's a bottleneck of energy, which is we don't have enough copper to sustain any projections that you see in data centers. So number one, the demand for copper is off the charts. But number two, we need a solution other than copper if the projections that are coming out are going to come even close to true. And there is something that NVIDIA, for example, and other companies are investing heavily in. It's called optical interconnection technology. And you can literally think about it as a way of using light instead of copper. In lieu of copper, you can use light. And there's companies that produce technologies that make that happen. Like I said, NVIDIA is investing in this technology, but nonetheless, growth portfolio is naturally heavy in tech. That's sort of the juice. That's the beta of the portfolio is tech. So naturally, we're going to have tech stocks in the growth portfolio. But we did want to add a copper stock into the mix. But what we were dealing with is we had already two gold stocks, two gold mining stocks. We wanted to add a copper mining stock just based off that research. We know the demand is through the roof. We love, supply and demand over here. It's easy, follow the logic decisions. So what we did is based on these reports, these screener reports, is, as you can see, I think they can see at least, there's a composite score up here, and it looks at all the things that we talked about, the innovation, inspiration, infrastructure, as well as the finite versus infinite game. And what we did is, okay, we've got two gold mining stocks. They're both great companies, Which one would we let go to replace it with a copper stock? It would be the one that has a lower score, because we want all the companies that we have to have the highest suitability to our values as a company. So what we did is we sold Goldfields Limited, which is one that also was 200%.
You're too much humility here, and maybe that's good. But we didn't have a scoring system before last quarter. Again, I just want to say thank you, because it's something I brought you in to kind of help us do. Carson took everything that I'd been thinking and doing and put it into quantified numbers. So now, we've kind of had this loose system, but it simplifies everything, takes a 3.5-hour meeting down to less, because we can take the things that we've been doing and the trends and turn it into actual numbers of how things, and we're going to talk about this in a minute. The numbers also showed us something that we hadn't seen before. But now we can go in and he can pull up a report on a company and be like, hey, based on everything that we've always been doing from the beginning, here's what the numbers look like. And so, again, I just feel like that just makes us better and better at what we're doing from a stewardship standpoint and thinking really ultimately the infinite game of the way that we want to own these companies. Again, and we're going to talk about results here before we step out of this. I'll just say this. I can talk to you about the audited results in the dividend portfolio. We are 1 quarter away from being able to start auditing the growth portfolio. So next quarter, hopefully we'll come in here and we'll have some numbers for you on the growth portfolio. On our back end, what I can tell you is it looks really good. It appears, not audited, that they are also beating their indexes. If you want to have a one-off conversation with your advisor or with one of us about what that looks like, but it continues to just reemphasize this common sense, this think like an owner, simplicity over complexity. Research reveals opportunities. All of those things come together to be able to help us get our clients to steward what you've entrusted to us well and to get you good results, which is what we're passionate about really creating. But I didn't want to interrupt you, but you just were like, oh, and we have this score, which we've never had before. So it's a big deal.
Well, thank you for that. So, yeah, we sold out of one of our gold mining stocks and we bought a copper mining stock. The other moves we made is we were underweight in utilities. We bought a company called Vistra, which is in utilities. We bought a company called Credo and a company called Marvel. And both of those actually deal with making the technology that deals with that sort of thing I was talking about, the optical interconnects. And that is a follow the money decision, a supply and demand decision. So I should preface by saying we had, at the time of rebalance, we had 24 growth stocks. We sold DocuSign mid-quarter, which we rarely do, but the reason for it is software had entered its own bear market, which wouldn't normally be a problem. But the reason is the purpose for holding DocuSign when we bought it no longer existed, to the extent that it was like, we don't need to be holding this. And the reason is mostly because it's sort of replaced by AI, and we could get into more of that. But we had 24 growth stocks, so we had to make 4 buys, and we did 3 sales. So I mentioned Goldfields, the gold miner that we had. We sold out of that. We had 2 companies, one Finvolution and one PDD Holdings that we sold, and that was based on values. And that was based on this screener report. And if you look particularly at and we could provide anybody a copy of this, but if you look particularly at the finite versus infinite game section, you'll see PDD specifically has basically no just cause. Obviously, we want a company with a just cause besides making the cheapest. This is Temu, by the way. Or PDD holds Temu as one of its companies that it holds. No just cause. We want a company that has, inspiration is one of the things that we look at very heavily. That's very important. If they're in the finite game, they're going to be inspired by something other than making the cheapest possible products and selling to the most people. Trusting teams and worthy rivals had low scores. And the information on these reports is really interesting to read through. And I'm not going to read through everything, but the fact that we have this ability now to actually take a deeper dive, like you said, almost like looking through a microscope at each individual company. Before, it was sort of, well, we'll just read as many articles as we can about the company. We'll keep up with the news, so on and so forth. But we have a way now with this screener report in order to actually look super deep into it. And PDD Holdings and Finvolution just no longer, after looking at these reports, no longer fit what our values are as a company. So anything you want to say?
Well, no, I mean, this finite versus infinite game really matters. And so being able to dig in deeper and have reports that come back. I think the other thing, too, it's one thing to be able to have this on. It was kind of like we'd come in every day and you would put something new in the software. Yeah. And I was like, this is really cool.
I was having a lot of fun this last quarter.
But, it's one thing to be able to evaluate all the companies we own. But, I mean, to the point now, you got every single company.
Almost. I've got 1,400 out of 2,000 companies that we could possibly buy. I've got 1,400. I've got 600 left to go.
Okay. Well, so you've put in a significant amount of companies so that at any point we can go in and go, hey, how are these screening?
Yep.
And how do these look? I mean, so it to me, it's not just being able to look at this. And then the other thing, too, we'll talk a little bit about this because proxy season's finishing up.
Yeah.
It's the first full year that we've been a client of Boyer Research. And I've had people who've come in and ask questions about but what if I don't agree with what they vote? Or what if my values aren't the same? Let me make a statement because I think this is important for everybody to understand. This is what we believe from a finite game to infinite game standpoint. When you're running a company, what we have found is the more political you choose to get, and I'm not right or left. This is not about which side you take. The more political activism you seem to engage, the more we start to find the company drifts off of what they're going to do. The thing that I'm impressed with Boyer is they've been going into companies and their request isn't for them to move right or left. Their request is, can we have neutrality? Can we have political neutrality? Now, what has been happening is a lot of the policies that have been in place are more maybe leaning towards the left and have disenfranchised some customers and some employees who maybe lean more right. So maybe that's why you disagree. Maybe you lean more left and you disagree with that. But the request really is we just want neutrality.
Yeah.
We're not looking for special favors. We're not looking for anything. And you're like, well, Eric, why are you fighting for that? And why are you doing that way? Here's what I'm going to tell you is I want neutrality because companies that do that play an infinite game and tend to perform better over the long term. So if a company's leaning one way politically, the other thing is, because I have had some pushback from certain people, certain people line up with this, a lot of the research that we use, a lot of the things that we look at might look like they're coming more from a right-leaning side of things. And I would say, well, yes, but do you understand that most of the research that I can purchase easily comes more with a left leaning? I need something to offset that so that, again, I'm just trying to get back to neutrality. Because what I've found is in neutrality is where common sense and business gets done.
Yeah.
And it's where success, and I think we come back to the results of what we're seeing over the long term. And I will just say this because, we're looking at 12.42% on the dividend portfolio over a 10-year period.
Annualized.
I'm sorry, what?
Annualized.
Annualized net. After we've been paid, our highest fee, the dividend index is 10.22. The S&P 500 is 14.05. So we're a little bit behind the S&P 500, but this is a dividend portfolio.
Yeah.
With less
more
volatility.
Portfolio.
Over a 5-year basis, it's 13.76% net versus a dividend portfolio at 9.7 and the S&P 500 at 11.93. We're earning money for our clients. We're keeping them, so long as the trends continue, we are on a path that should have us less volatile, and all we're doing is following just this common sense themes. And what you're going to find is my commitment is to the discipline of think like an owner, simplicity over complexity, and research reveals opportunities. And then we're just going to run the same discipline playbook because when we get emotional or we bring, I feel like, or my gut says, every single time I've ever tried to do that, I've made a mistake. And so I'm excited about what all this pulls together, and I think we're going to keep looking for other things that make us better and smarter. But for those of you who maybe even have resisted doing the proxy voting, I would encourage you to rethink it. And the reason is because one of the things that Boyer did is they went into a few of the companies like Lockheed Martin. Before anything ever got to a vote, Lockheed Martin was starting to do some things that were political and said, hey, could you guys just be a defense contractor?
Yeah.
Could you just do what you do really good instead of, they didn't ask for any special favors. They said, could you be a defense contractor? And it was before they got a vote, and they're like, oh, yeah, no, that makes sense. We'll just be a defense contractor. And so it never got to a vote. So I was impressed at the work they were doing before it even got to proxy voting.
Yeah.
So it's an incredible partner for us. So do you have anything else?
One more thing that I'm excited about is there was one thing that I've been really thinking about is when we do tax loss harvesting, we have to buy something. What we usually in the past have ended up doing is buying a dividend index, buying a dividend ETF. And the problem with that, really the only problem with that is that it's sort of just like, well, we care about the companies that we're investing in so much that I don't have control over what's in this ETF. And so we bought things like SCHD, Swap Dividend, and DivB, which I think is BlackRock. But I recently came across an ETF the ticker is RDVY, and it's issued by First Trust. And I met with a guy who works for First Trust, and he explained this ETF to me. And I have nothing else to say other than I just feel way more confident and better about, when we get to the tax loss harvesting, that I have this ETF to put money in when needed, because the stocks are screened very similarly to the way that we screen. So I just wanted to bring that up because I'm excited about that too. It was like something missing that I'm glad I found a resolution for. So.
That's really good. I want to add to that because we did do some loss harvesting this year. We had a whole webinar on taxes earlier this year where we talked about it. But I'm going to just tell you guys, like we said, year 3, managing a portfolio without a whole lot of volatility. We did some loss harvesting this last quarter with the market down. This is not audited. Again, 5.50% year to date as of the end of March 31st. Today is, you're watching this recording on March 22nd. I was recording this on March 21st because I had to travel. But it's up significantly more than that since then. I don't know where the year's going to finish. I told you what, I think there's a high probability we could see some more volatility come in and we'll turn back. We're running into taxes again.
Yeah.
We're making a lot of money. That's a good thing. But we're trying to manage through it. But I tell you right now, it's like if you have thought about doing any charitable giving, use your portfolio, please. That's going to help you. That's going to help us. You can, we talked about this in our webinar with Danny. There's things such as donor advised funds. We kind of nicknamed them giving checking accounts. Like, I don't know where I want to give the money yet. That's fine. You can go ahead and put the money into those, and you can get a tax deduction now and make your giving decisions later. We are all big fans of this. If you're like, I'm just going to pay the taxes. I was on the phone with a CPA, and he was like, oh, I'll figure out where to get the deductions. Just whatever I'm going to have to do from a tax standpoint, just keep making me money. And it's funny to me, but you know, I've got a few clients that are CPAs. Do you know who complains the least about having to pay the taxes?
Is it the CPAs?
It's the CPAs. I thought that was funny. Anyway, so we're going to wrap this up with 2 things, and then we're going to open it up to Q&A. So if you're watching the recording, you'll be able to come in and ask questions. Carson's here, Drew's here to take you through any Q&A that you have. But remember, we can't record Q&A, so we're going to have to cut off the recording and then let you come in and do Q&A. But if you're subscribed to the Rich Report, you also got a copy of what changed and why. So Carson sent this out after we made all of our portfolio changes on everything we just went over. You've already had the report. What did we sell? What did we buy? Why did we change it? What did we do? So if you're not subscribed to the Rich Report, info@paradiem.org. You can send an email and ask to get subscribed. We'll get that sent out to you. You're getting your weekly economic news and what changed and why. And then lastly, we're doing these webinars monthly. On May 27th, we'll be back at 10 a.m. We're going to have the Fussell Group here talking with us about understanding Medicare. A lot of clients are kind of facing Medicare decisions and how to think about that. And it's not my expertise, but it is theirs. On June 17th, Taya will be back with how to make an inheritance a blessing and not a burden. So as we keep having our conversations about how do we align family and capital with a 100-year vision, how do we think about using that inheritance and making it really be a blessing for those generations? So June 17th at 10 a.m. And then you and I, a quarter will end again before we know it. We'll be back July 22nd at 10 a.m. for the portfolio outlook and update for second quarter. So with that, Carson, thank you for being here.
Absolutely.
All right. Thank you, everyone, for joining us. If you have any questions, reach out to me, reach out to Carson, or reach out to your advisor. Thank you so much for being with us.